you'll learn and know how to earn more money and give
Uh,
your money more life.
Absolutely. Tuki, let's recap again for those guests that got here a little
Hi
after we
guys.
got started. So we have two dilemmas: how to make more money and how to give your money more life.
Right? The four phenomenons that caused us to have these two dilemmas, doesn't matter what generation you're in, is the income, family, retirement, and the new six figures. But we have the solutions.
We have the solution because we have not only the money matrix that we're talking about today, where you're going to be able to learn about
All of the different ways that you can maximize your money, give your money more life, understand how to be in how to be in a more secure than an unsecured account. You'll understand tax codes, and we'll even give you like some scenarios about different ways that you can see from one person's perspective and another. Because I think when we can all learn from each other, we'll have a greater understanding.
absolutely. You know, we're very excited that you guys are here with us today, and we are humble and grateful for your presence today and for your attendance tonight. You are in for a treat. You are in for a treat. And we want you to know that it is important for us as the leaders of the financial revolution that you get your money's worth. And you're only going to be able to get your money's worth if you understand the basic principles, how money works, how money grows, and how money multiplies. The one common thread, Tuki,
Mhm.
that defines everything that we do in life, where you go to school, the car you drive, the house you live in, the food you eat, the future of your children, the future of your children's children, everything. It defines it. Yet we're afraid to talk about it, and that is money. We're not afraid at HEI, and we're not afraid at the money matrix. Today, we're going to be we're going to talk about money. We're going to get completely naked, and we're going to give you some solutions on how to give your money more life. That's exactly what we're doing tonight.
I love it. Learn how to maximize your money, learn how to grow your money. Grab a pen, grab some notes, and without further ado, we have the iconic, we like to call him Mr. Wizard of Oz here, because he makes all of our technology and allows us to leverage AI, like I said, to use it for good. We have the incredible Mauricio Garcia.
Hey guys, so I'm just here. What a phenomenal job you guys really did. But I'm really just here to help this run smoothly. Obviously, we have the architect of this event, the great Jody Humphrey. Many of you may know him. Many of you have. This may be the first time that you're hearing from him, but this is really a result of his vision and what he wants to do to spread financial education, financial literacy. So I'm going to.
Indeed, his vision. He is a visionary. He's been in the forefront of this incredible, momentous impact that HEI is creating across America. They have democratized, digitized, and monetized the financial institution system. They have literally brought Wall Street to Main Street. So now, with any further ado, I want to introduce to you our friend, our partner, our incredible leader, our Hall of Famer, the man, the myth, the legend, Mr. Jody Humphrey.
All right, guys, thank you for being here, and so excited to have you here tonight. Yeah, we're excited to be here on YouTube. There's going to be a great program tonight, and this will be also saved so we could have thousands come back and watch it as we're going. Welcome to the Financial Matrix. You know, what a great place to be. And ironically, we're having it on April 15th, so we're trying to give you some relief for that hit that you took tax-wise earlier today. And we're going to make it end with hope versus feeling helpless. And that's what this is really all about. You know, tonight you're going to hear some things that I hope you're going to find life-changing. I certainly have found them to be so. You know, I think that right now financial literacy is at a premium. I think that people are waking up every morning feeling gloom and doom just because they don't have a plan. We're going to teach you how to play offense and defense with your money. We're going to teach some things very fundamentally, very succinctly tonight that you should have learned when you were in the 8th or 9th grade. We're going to make sure, you know, the best time to learn something would have been 20 years ago, but the second best time is right now. And we're going to render you excuseless right now. And you got a world-class panel tonight. You're going to first hear about some fundamentals, you know, the blocking and tackling, things that you need to know to start out your financial house, going out and building a house that can go last generations, which is what you all want. Everybody wants to be great. Everybody wants to have relief, live wonderful lives, and be in control of their financial future, but they really don't know how to do it. So we're going to arm you, I think, with the greatest tools you're going to ever see in this business. And then after we go through and get you fundamentally sound, then we're going to go over to some strategies. We're going to go through and have you learn about something called tax now, tax later, and tax never. How would you like to find out about that? All of you know that there's people out there who know some secrets to how money works, but no one brought them to you, and you're going to hear them simplified tonight in a way that's going to blow your mind. And then we're going to hear about Be Your Own Bank. That's what's called infinity banking. That's a real, clever name for a concept. And don't be, swayed by clever names. We're going to simplify things, and you're going to hear more about how that can work for you. And then you're going to find out how to protect your retirement. Those people that have accumulated money, they've got a whole nother set of problems than those of you trying to accumulate some money. Because if you have accumulated it, we're in a very volatile world, especially if you're 10 years, 15 years from retirement. You can't have any crazy stuff going on because you don't have the time to overcome that. We're going to teach you a concept that's just going to absolutely give you, it's going to make you sleep better, and it's going to make you want to go tell it to everybody that surrounds you. And then finally, you're going to find out some higher level concepts of how to go out and really learn how to use IRAs in strategic ways that you've never thought of before. So we're going to have an incredible night. I want you to hang on and listen with an open mind. You need to sit here also with a notebook, because this is for you to go learn. That's what we're here for tonight. So I'm very excited about that. I am Jody Humphrey. I'm blessed to be part of this leadership team. I get a lot of compliments here, but we are a group effort. All this is very well planned, and people are prepared, I think, to do a world-class job for you. And I think we've been able to be the biggest financial distribution point in the United States. And we have a system that's done that for the last 40 years. We've been able to go out and help more families. Our goal is to have 1 million families that we help become financially independent by the end of next year. Now that's saying something, but we're on target to do it. That's what we're really all about, is to empower you in a way that can change your life. So I look forward to coming up after each one of these great speakers and segue into the next, but also want to make sure you know that this is being translated into Spanish. So we'll pull up this slide here. This is a translation slide that we have, so that you can, if you're here and you habla español, that you can use this translation number. We're going to pull it up here in a second. Hopefully I know the great James Ivanovich is helping me with this. So let's pull this baby up. So Mauricio, can we pull up the translation slide here?
I'm back. All right.
Yes, got it.
James, do you have the translation slide, James?
Yes, sir.
All right.
Yeah, just pull it up.
Oh, here we go. You got it. There
Thank
it is.
you.
Right there.
Traducción, right? So here's the information. Take a picture of this, because we're not going to be able to come back to this. We might pull this up later, but we want you to have this now. We got a great Octavio, does a world-class job for us. So there you go. Let's put this also maybe down in some chat information as we can. Thank you very much, James, for doing that. And now as we get ready to go into this presentation, which is good with James here, we're going to get going. And James Ivanovich is going to be our first presenter. He does a world-class job. He's going to talk about the principles that you need to know for that very basic building blocks. The things that the kind of the faith, repentance, and baptism, if you will, of what we do. The very principles are that this whole thing is built on. And those are things like compound interest and pay yourself now. And he's going to do a phenomenal job of that as we go in and simplify. Remember that movie, The Matrix? Is people went out and it was complicated till it became very simple. Remember that point? That's what's going to happen to you tonight. It's going to all slow down, and you're going to love it. So, James, powerful financial professional. James, take over, buddy.
Absolutely. Hey, good evening, everybody. We appreciate everyone taking the time away from the family, away from the dinner table here on this beautiful, beautiful Georgia evening that we're having here on tax day, April 15th. I know it's a crazy hectic day for everyone. Hopefully you guys got your tax returns entered in on time to avoid the IRS and avoid any of those heavy penalties. No one wants those, right? But again, we do appreciate everyone taking the time away from the family here to join us this beautiful, beautiful Wednesday evening here on Hump Day, guys. We're here to give you the best, and we want to hit you guys quick and hard with some of the greatest, latest information that's available to you out there that many of us, again, we never learned this in school. We never learned this at home. And chances are, we may never learn it unless you get in front of one of us or a financial professional in your world, in your network, that can kind of really help guide you, direct you, and educate you on these concepts and these principles, guys. That's what it's all about. It's the financial matrix. Because at the end of the day, guys, it's all about how to win the money game. Okay, we got to win the money game. Why is that so important? Because now is the opportunity to win. Believe it or not, guys, again, I get asked all the time, what do I do with my money? How do I grow my money? How do I multiply it? How do I protect it? How do I preserve it? How do I transfer it for future generations to come? Those are all great questions, guys. But if you're going to be in the game, which we all are, whether we choose to accept it or not, guys, we're all in the money game together. And because we're in that game together, we got to know the rules behind the game, guys. Because, you know, if you're going to play in any game, doesn't matter what the game is, you got to know what those rules are. You got to know how to play the game to win the game. And this is that opportunity. You know, Jody had mentioned here just a short moment ago that in the world that we live in, pardon me here, I got a few moving parts. In the world that we live in, when's the best time to plant a tree? 20 years ago. When's the next best time? Right now. Again, procrastination is the assassination of your end destination. And so right now is the time to take control, guys. You know, the secret to financial security is learning to control the things that you can control. That's what it's all about, guys. You want to be able to pay yourself first. It is so crucial that discipline is everything in life. If you're going to achieve anything in any great area of life, whether it's in your relationships, in your family relationships, your personal relationships, your financial business partnerships, all of those key areas of life, you got to take control. And you got to have the discipline to take care of you first, right? To make sure that you're truly on path to hitting the target that you're going after. But when it comes to winning the money game, you're never going to win the game if you're taking care of everything else and everyone else, but not taking care of you first. In fact, what I challenge a lot of my clients is to always take control, discipline yourself, and treat yourself like you're the biggest debt, the biggest expense every month that needs to get paid. More than that rent, more than the mortgage, more than the light bill, the phone bill, all the other insurances that you have, all the other expenses that you have each and every month. You are your biggest expense. So put you and your family first over any other obligation that you have. And by doing that, you've now set yourself up for future financial success as opposed to continuing possibly going down that path to financial failure. You got to earn additional income. It's getting really hard and tough out there in the world today, guys. Again, I mean, it's 2026. Wake up. AI's taking over. People are getting laid off right and left. I mean, everything's going up. Cost of living, inflation, interest rates, taxes, rents, more, our mortgages, everything's going up, right? But what's going down? Our paychecks at work. Our paychecks are getting diminished. They're getting squashed. They're getting eaten up by all the additional expenses that we have to face now each and every day, each and every week, each and every month. And again, it's forcing Americans to now have to go out and find a second or third income stream just to stay afloat, just to compete in today's world. And it was never always like that, guys. But again, we got to change. We got to adapt with times. And so right now, more than ever, we have this huge surge, this entrepreneurial explosion happening coast to coast, from the north to south, east to the west, all across this great nation, all across the world right now. And again, there's no better time to start a business than right now, especially with all the technology that we have access to. The abilities to be able to meet individuals live on YouTube all over this country, if not all over the world right now, is incredible. So why not build a business and with the technology that allows you to do it, to build that additional income stream, to be able to now then have that extra income that you can now discipline and pay yourself first and really start to build that financial nest egg that you've wanted to for so long, but you never could because you were squeezed so thin. Again, we got to make these adjustments. And by adjustments, we got to adjust our lifestyle. We got to understand the difference between what we want versus what we truly need. Our priorities are everything in life, guys. And I hate to say it, but we live in a act backward world, so to speak, where we buy things with money we don't have, things we don't need to impress people we don't like, right? Isn't that the world that we live in? It doesn't have to be like that, guys. Again, we just need to make these minor adjustments and ask ourselves, do we really want it or do we actually need it? Because when you start putting your needs over your wants, you start to realize you actually have more money than you ever thought possible. But we just got to take that control. Avoid the credit trap. Oh my goodness. How about them gas prices, right? More and more Americans now are starting to put gas on their credit cards, guys. It's getting tough out there. Again, gas prices are also going up. Everything's going up, right? So is credit card debt in this great country. Credit card debt has now surpassed over $1 trillion. It never was like that before. And yeah, the national debt continues to grow and climb and soar. But guys, again, we got to avoid that carpal tunnel syndrome of swiping the credit card, right? It's getting too easy. And, again, we got to pay off that credit card debt too. No one wants to carry that debt. Heaven forbid something happens to you. Now that debt transfers to the loved ones in your family. You don't want to transfer them your debt. No. And again, we gotta take responsibility. We gotta ask ourselves, do we need it? If we need it, is it best that we actually put it on the credit card, or do we pay cash for it? Again, guys, we just got to be smart, be responsible. Through all of this, it's all about changing your way of thinking. Change your financial paradigm. Change the way you think and view and handle your money. Money is a vehicle to be able to afford to build a great life for those who have it. But guess what? Yeah, not everyone maybe has all the money in the world, but guess what? You can still get it. It's available for everyone. And again, when you start to change your stinking thinking, so to speak, guys, things get easier, things get better. You start to see more opportunities and abundance in your life. You can have an attitude of massive success, or you can have an attitude of failure. Again, having an abundance mindset versus a famine mindset. And by doing that, it's going to overall change your life and the course and direction of your journey as you go through it, guys. Again, time and consistency. You pay now, you can really pay you later. Time and consistency are key to building wealth, guys. It's so important to start saving early in life. How many of you watching right now, and I know it's got to be the majority of the people that are on with YouTube Live right now, guys, watching this. How many of you grew up in a household where one or maybe both of your parents said to you at an early age in your life, my parents did this to me, start saving your money when you're young. Don't make the same mistakes that I did, because I don't want you to end up exactly where your mom and I are right now, right? Which, love my parents to death, but, again, our parents, they always want the best for their kids, right? They always want their kids to grow up in a better life and have access to more things, more resources. Again, have that abundant lifestyle and ability to capture that abundant lifestyle, right? Well, but again, it all starts with starting early in life. Again, the later we start, the harder it gets. And so the key is that the longer you wait, the less doubles you're going to get on your money in your life. Because there's 3 core principles to building wealth: time, rate of return, your interest that you make on your investments, and the principle of what you're actually putting in on those investments, the principal amount of money. Well, you can control your principal. You can't really control the rate of return. Time you can most definitely control, but you got to start soon. You cannot delay. You cannot procrastinate, because you're just going to miss out on additional doubles on your money that you otherwise would have been able to capture had you started earlier in life. Again, it's not only important how much you save, but how early you started saving. Okay, we're going to look at 2 examples here. Okay, I really want to stress the importance of starting young, starting early, putting money aside. And this is a great example of a 25-year-old that decided early in their life that they're going to start early. They're going to take $300 a month or $3,600 a year, and they're going to invest that into a tax-deferred investment. And it could be there's different types of investments out there. We're not going to get into specifics here, but we're just using a concept, okay? That $3,600 a year across 7 years invested, that's a total of $25,200 in contribution, okay, is going to yield $128,000 by the time that individual at 25 reaches age 48. Not too shabby. And again, and that's based on an 8% tax deferred account, 8% rate of return. Well, what happens if that 25-year-old, he's out there, he's running around, he's blowing his money, as most young 20-year-olds are, right? We've all been there. I've been there. They decide, well, I'm not going to start at 25. I'm going to go ahead and wait 7 years. I'm going to start at age 31. And so then they start at 31 and they take that same $300 a month, $3,600 a year, and start investing that into a tax-deferred vehicle that grows at an 8% rate of return. Only now they're having to invest $3,600 a year for 18 years of their life versus 7 years in the previous example. So that's a total contribution of $61,200. And what do they yield? $131,000. Okay, so they got a couple $1,000s more in that scenario by investing $61,000 versus in the previous scenario, had they started sooner and only paid in 7 years, not 18 years, only put in $25,000, not $61,000, they would have netted and yielded the same result. And so who wouldn't want that earlier example? Who wouldn't want to put only $25,000 in at an earlier period in their life versus having to put $61,200 in and having to put that in across the span of one's life just to get the same amount? Doesn't make sense, right? So again, start early, start sooner, start often, okay? Now let's talk about a big principle here. And again, we deal with a lot of CPAs and a lot of tax professionals. Many of them don't even know this concept. They don't know the rule of 72. And for many of you that are joining, maybe you've heard about it. Maybe you're starting to hear a little bit more of it through social medias and whatnot. But I guarantee you, many of you may not even know what the rule of 72 is. But the reality is we've all heard of Albert Einstein. We know who Albert Einstein is. Obviously, we learned about him in school, right? At whatever level of education. I'm sure everyone here learned all about Albert Einstein, how he's one of the biggest geniuses of all time. Well, he actually coined the rule of 72 here as the 8th wonder of the world, and actually said that it's either working to benefit you or it's working to destroy you. So what is the rule of 72? Let's dive into it. The rule of 72, quite simply put, is the ability for one to be able to get more doubles on their money in their lifetime based on taking an interest rate of return. So for example, the example on the screen here is 2%. How many times does 2 go into 72? 36 times. So every 36 years, this individual, age 29, who invests $100,000 at an interest rate of return of 2%, is able to double that 100,000 to 200,000 within 36 years, or at the age of 65. Not too bad, but 2% is a low interest rate, right? We could do better than that. Of course, we could do better. Inflation's 4%, so we need to at least be getting rate of return of at least 4% just to compete with inflation. So let's go to 4%. How often does 4, or how many times does 4 go into 72? 18 times. Okay. So now every 18 years, this individual, age 29, with $100,000 invested at 4% rate of return, is able to double that money every 18 years. So at 29, 100,000. At 47, 200,000. At 65, 400,000. So in this scenario, in this example, at 4%, they were able to take advantage of 2 doubles. Okay, well, if 2 is half of 4 and 200 is half of 400,000, I would believe if he got an 8% rate of return, it'd probably be 800,000, right? No, it's not. It's because he got more doubles than he got in the first 2 examples. Let's dive in and take a look. 8%. 8 goes into 72 9 times. So every 9 years, this individual, age 29, with a $100,000 investment, is going to be able to double that 100,000. So 29 at 100 becomes 200 at 38, becomes 400 at 47, and then becomes 800 at 56, and then 1.6 million at 65. So every 9 years, that money is double. It's doubling. It's compounding. It's basically like saying, do you want multiplication on your money, or do you want simple arithmetic? You want addition on your money? 8% simple linear interest is not a whole lot of interest as growth. Would you rather have simple linear interest, a rate of return of 8% to have 388,000 by 65? Or would you rather have compounded 8% rate of return on your investment and have 1.6 million at 65? So again, that's the huge difference, guys. So by the way, if you're putting your money in the bank account, you're more or less, that's getting simple linear interest growth. You're not getting compound growth on your money just sitting in a bank account. You might as well go bury it in the backyard. And by the way, you're probably going to lose against inflation, because inflation's always been 4% every year. And unless you're getting at least 4% rate of return compounded, again, you need to find a better vehicle to put your money in, guys. So again, I appreciate the opportunity, Jody, for hopping on and sharing just a couple tidbits. We'll go ahead and kick it back over to you and keep the show rolling.
My goodness, fantastic job, my man. California kid does it again. Love it, love it. Thank you for that fundamental information. And here's the thing, guys, I want you to understand, the thing that sets us apart, and the reason tonight will be worthwhile, is a lot of people will stop when they teach you that part. But that's just part of it. Not only do you have to get a good rate of return, but you've also got to make sure you don't lose your money. And then you've also got to make sure that you take the right proper tax strategy. And you're going to learn all those things next as we ratchet it up a little bit more here. And you're going to hear from the best in the business. Zach Odie is a professional with us and has built a tremendous business. He's also, I think, one of the best teachers. He comes from a great teaching background. And I think he's going to explain some of the principles that's going to absolutely blow your mind. So here to take it up to another notch. And if Mauricio's a Wizard of Oz on technology, you got the Wizard of Oz when it comes to tax-free growth of money right here. Zach, knock it out, buddy.
Jody, I appreciate it. Man, this has been fantastic. I got to up my glasses game. Peter made us all look, if I got to wear these to read, I should at least get something that looks good, right? what a bunch of fantastic information. And I'm honored to be here tonight to talk to you guys. I hope that you're prepared, because we call this the financial matrix for a reason, right? We're referencing back to the series of movies. And it was even talked about earlier tonight, the red pill, blue pill moment. And guys, this is that moment. If you stay on this call, which I hope all of you do, that are here watching this video, what you're going to have to do is take a red pill. The blue pill of bliss, if you will, meaning that your life is undisturbed and you don't realize that you're just putting one foot in front of the other, is something that's got to go. If you want to make a difference and you want to get ahead for yourself, like James said, you've got to understand how these concepts work. And you've got to realize that just because everybody else is doing it, or you think that it's the right thing to do, doesn't mean that it is. So let's start taking a look at sources of income during retirement. Now, we're very, very good at operating on really outdated information. We have this relationship with money that is very strange. A lot of times we're dealing with the same type of advice or money parameters that our grandparents taught or that our grandparents functioned under. So let's talk about this. When you get to retirement, this is the old way, right? That we used to call this the three-legged stool of retirement. These three things, one of them, Social Security. You can't get online and look at money forums and talk to people about Social Security without hearing at least one or two people question the strength and solvency of the Social Security funds. The next one is a pension. Now, we met with a group of 24 to 28-year-old folks a few nights ago, and I said something about a pension, and you could see the glass in their eyes. They had no idea what a pension was because nobody's got it anymore. We had one person in the room, and they're 5 years from retirement, or maybe even 5 months from retirement, that knew what a pension was. And then the last leg of that three-legged stool is personal savings. Now, the reality of it is that we've got a new way that we need to be planning. A new way we're planning, we're just not doing it the right way. In reality, what's the number one vehicle that people are using across the board to save for retirement? It's a 401k. It's IRAs, 401ks, 403bs. They are all treated the exact same way. Whose money is in the 401k? It's yours. It's your money. The only leg left on the stool that we can really count on is our own personal savings. So like James said, if we're not aware and we're not doing what we need to do to move forward and make that leg wide enough to support that entire stool, then we're in trouble. Now, the real thing is, I say, whose money is that in that 401k? And everybody's thinking, like I said, it's your money. But you have a silent retirement partner that's in that account with you that owns 25 to 45% of that money. And that's our great Uncle Sam. The 401k programs that we're all contributing to right now, every single dollar that comes out of that in retirement is going to be taxed at ordinary income. There's no capital gains, which is a reduced tax rate. There is no way to get around it. So every single dollar accumulated inside that vehicle, you're going to pay ordinary income tax on. And the key is, at what rate? Do we think taxes are going up, or do we think taxes are coming down? Has anybody taken a look at the U.S. debt clock recently to see what the debt looks like? When the debt goes up, taxes go up in order to pay that debt. So I know there's a lot of things going on right now in the economy that we don't really know what's happening, but we can certainly use the information that's out there. And that's why we want to bring this to you. So take the red pill and hold on, because I'm going to talk to you about some things that you may not have seen before. Now, if I were to show you this magazine cover right here, and you saw Time magazine, and they're pretty reputable publication, it says, why is it time to retire the 401k? You might say, ooh, wow, this is current. I need to read this. I need to find out more about why it's time to retire the 401k. What if I told you this was the headline in October of 2009? And nothing's changed. No one has changed the way they invest, at least not systemically. We all still go in, sit down with HR, we take the 401k and the match, and we overfund it. And that's what we think we're going to have enough money in at the end of the day. But in reality, if that's your only bucket, you better be funding it really, really heavily, because 25, 35, 45% of that money is going to be shaved off the top of what you get every time you take money out of that vehicle. So what I'm going to do right now is I'm going to talk to you, and I'm not saying 401ks are bad. Let me be clear. I tell everybody when I work with them on their retirement planning strategies, you want to go free money first. So free money, tax-free money, and then taxable money. That's the order in which you want to invest. So free money is what? It's a match on the 401k. If I put in 5% and my employer puts in 5%, just because I did that, I've got a 100% rate of return on my money. I'd be crazy to try to beat that somewhere else. But the question mark is when I go over the match, should I do that? Is my tax deduction now worth my tax payments later? I don't know. We're going to talk about that for just a few minutes. So it was mentioned earlier in the pre-show about this story. And what this is, and guys, this is a concept. It's an educational piece. I'm not saying this is the best thing for everybody. I'm not making recommendations. I have to throw that out there from a compliance perspective. Like James said at the very beginning, you need to have a professional that helps you through these things. If this is something you're interested in, we here at HGI are across the board, full service financial operation. So we don't just sell one product, and we don't just sell from one product provider, if you will. We have stock market products. We have life insurance products. We have real estate products. We have all these different things that we can offer. So have somebody put together a plan for you. And if somebody invited you to watch this or you happened on this, then comment to our Team Legacy YouTube page, and somebody will reach out to you about setting that appointment and getting that done. So let's talk about this concept. We got two brothers, Brother A and Brother B. Brother A is doing it the old way. That's using the 401k qualified type accounts. These are run out, and as far as comparing apples and oranges, I will tell you they're run out exactly the same. 35-year-old male, 2 children, both saving the same amount of money each year, and they're compounding at a 6.65% rate of return. Yeah, so you can beat that in some places. You can do worse than that in other places. I wanted you to understand the concept, and we can talk details about that later. I'm a spreadsheet nerd, so if you want me to dive into something later, let's schedule an appointment to get that done. So Brother A, the old way, is putting in $6,700 in contributions to his 401k, but his employer match is only $1,000. So he's way overfunding beyond the match. And Brother B says, you know what? I don't want to do the 401k. I understand that most people that are younger than 35 years old right now are going to change professions 4, 5, or 6 times, not just jobs in the same profession. And so a lot of them are going to go reach in and take that money out and pay off debt or do something else. He's like, I want a portable pension plan. I want to start something that's not attached to my employer. So I'm not going to be involved with the 401k. So therefore, I'm not going to get the match. So next thing, here's what happens. Brother A is like, I got 2 kids. I've got to get some life insurance. So he buys a $250,000 30-year term for $500 a year. Brother B chooses as his vehicle a permanent life insurance product called an Index Universal Life. He puts all $7,200 a year of his contributions. You guys see the $6,700 plus the $500. He puts all $7,200 into that product, has the same death benefit, right? Let's look at this. $7,200 out of pocket. Which one of these people made the right decision? And you're probably sitting there going, I don't know. This sounds kind of strange to me. I'm not sure what's going on. Let's keep going. Results after 30 years. So now we started, like James said, start early and then stick with it, right? So they stuck with it. After 30 years, Brother A has $708,000 in his 401k. It's still subject to market fluctuations, and principal is not guaranteed. One of the reasons that magazine article came out in 2009 was that was the first time that a generation of people were solely dependent on the 401k for their retirement funds right after a market collapse, right after a major market downturn. You've heard the joke, 401k turns into 201ks. That's what they were talking about there. So all the way up to the day you actually protect these assets inside a 401k, they are subject to market fluctuations. Principal is not guaranteed and your gains are not locked in. Let's see what Brother B looks like. All right, so the number at the top is a little smaller. He's got $619,000 in cash value inside of his index life, not subject to market fluctuations because it cannot lose once it locks in those gains. Principal's guaranteed, and like I said, the gains are locked in. Let's take it a step farther. Let's take a look at the life insurance. You think after 30 years he still needs some life insurance? Probably so. Well, Brother A's 30-year policy has just lapsed. He can't afford to pay the premium anymore because it's over $10,000 a year, and it's just too expensive to replace it. Well, Brother B has got an $842,000 death benefit on his index life that also has living benefits. In case he gets sick or has a chronic or critical illness, he can withdraw some of that or reach in and use some of that death benefit while he's still alive. So not only does he have a massive death benefit and his kids and his spouse are protected, but he's also got all these other benefits that are associated with that. Now, he's going to stop paying in. So they both stop paying in at the same time, right? So here we go. Talk about those tax savings. I talked about that deferred taxation in the 401ks, IRAs, those kind of things. You know, the federal government knows exactly how much money to the penny is inside qualified accounts right now. And a qualified account is one where the taxes haven't been paid yet. That's what I said, 403bs, 401ks, IRAs, those kind of things. And they know exactly how many people are turning 59 and a half, how many people are turning 70 or 72, and they're going to have to start taking this money out. They know that, and it's part of the budget, right? I have a whole nother presentation on the history of the 401k that I can't give you guys tonight, but I'm telling you right now, it's a fantastic thing for you to understand. So he saved $65,000 estimated over those 30-year period while he was investing. So he beat Brother B there. Brother B had zero tax savings. Which one of these guys makes you feel more financially secure? I mean, you know, depending on where you are in life right now, you might say, I like 708 better than 619. I don't need life insurance, right? You might have different ways of thinking about it, but stay tuned. Let's look at during retirement. So you've got in your retirement phases, you've got accumulation phase. That's climbing the mountain, right? And then you've got what do you add at the very top? So that's where I got. Now, what do I do with those assets? And Kimberly's going to talk to you guys about that here in just a few minutes. And she's fantastic at what she does. But then you've got distribution years, right? Throughout retirement, what do we do with this? So Brother A, $708,000 total retirement income. He needs $55,000 a year after tax. In order to get $55,000 a year after tax, he's got to withdraw $70,000 because remember, he's got to pay ordinary income tax on every dollar that comes out of that 401k. So $70,000 withdrawal. He's going to pay $15,000 in income tax every single year. Let me explain something to you guys. How much did he save over 30 years of accumulation? $65,000, right? So let's do some real quick math. I was a teacher right out of college. That's what my college degree says. But I'm telling you right now, 15 plus 15, that's year one and year two. That's $30,000. Year three is going to put him at $45,000. Year four is going to put him at paying back $60,000, assuming tax brackets don't go up. So in year 4.5, he's paid back every single cent that he was able to save throughout his entire accumulation phase. And assuming the market cooperates during that distribution phase, he's going to be out of money after 17 years. So he's got no life insurance. He's got no money left. What's his option? What can he do? Go back to work again. Now let's take a look at Brother B. $619,500 in total assets to withdraw or to take out for retirement income. Now, he's also going to take out a $55,000 annual income, but he's going to do it in the form of a loan from his cash value inside his life insurance policy. So it's a tax-free loan. That income is tax-free. According to the IRS, proceeds from a loan are not taxable. If I go borrow $30,000 to buy a car, I don't have to pay the IRS tax on the money I borrowed, right? I might pay sales tax on the car, but that's why these rules work this way, because it's a loan. It's not a withdrawal. That's also why, I'll tell you the number here in just a second. That's also why he's able to draw out for many, many more years. But look at this. He pays zero income tax through the entire distribution phase of this. After 30 years, he still has $455,000 of cash value at age 95. And he also has $498,000 of death benefit and living benefits remaining at age 95. How important is that for his heirs, for the assets to pass the way that they do? Now, I could explain to you how this product works in a lot of detail, but what I want you to know is you need to schedule a meeting with whoever got you to this right here so that you can get your questions answered. I love explaining that. I see the red pill moment. I see people's mind get blown. Their eyes just open up and why don't people know this? And it's just because we're operating in that financial matrix. We're living plugged in to a source of information, right? So it's not how much you make, it's about how much you keep. So let me wrap this up, this little story real quick, and let's talk about Brother A and Brother B line by line. 708, 619. Brother A wins, right? 65, 0. Brother A wins. This is where your CPAs are. Their job right now is to save you money this year. Today's tax day. We've talked about that. You think your CPA is a hero if you pay less this year. Our job is to help your income run longer at the end of the time accumulation time. 70,000 annual income because he had to get the 55, he had to take out the 70. But look, on paper, according to his tax return, right? He took out $70,000 in ordinary income. Brother B has 55,000, 15,000 income tax. Whoa, wait a minute. Top 3 lines, Brother A's winning. Brother B has come back, right? 0 income tax. 55,000 net, 55,000 net, exactly the same here. 17 years to 0 with market cooperation. Not bad. He had 708 and he withdrew 935 at this point. Take a look at this. Brother B, after 30 years of withdrawal, this guy ran out of money at 17 years. After 30 years of withdrawal, he's still going, taking out a $1.6 million tax-free, and he still has death benefit left over. Now, the number one objection I get to this when people are looking at those top 3 lines, right? They're like, I don't know. I don't need life insurance because I don't need to buy it right now. Or I don't want to pay for life insurance. I want all my money to grow for me. Well, guess what? Would you rather pay $255,000 in taxes and run out of money early? Or would you rather pay $173,000 in policy costs over that 30-year period and still have value? Your family's been protected. You've had living benefits. And now you've been able to take out from a smaller cash value amount. You've been able to take significantly more money out tax-free over those years. Caps on the typical amounts that the typical accounts have caps and things like that. 0 restrictions. It's portable. I can take it with me. I don't lose it when I leave my job. When structured properly, I throw that out there because you've got to understand, you've got to work with somebody that knows how to build these contracts to work the way I'm talking about. Now, let's talk about life. Let's talk about money. Let's talk about types of investments. So the risk return paradigm here, and I borrowed this from a guy named Doug Andrew. He's a great, been in financial services for probably 50 something years. If I've been in it for 23 years, he's probably been in it more than 50. But if you talk about common investment types, you can see all these that are listed over here. There's different things that we want to see how they perform against, right? And so number one is we want our money to be liquid, right? I don't want my money to be tied up necessarily and I can't get to it. So if I look at liquidity, it takes out all these right here. Now the next one is safety. If I don't want to lose, what do I worry about? I worry about safety. So that takes out several more of these blocks. Next one, rate of return. I want to make sure I can outpace inflation with my potential rates of return. And then finally, a tax-favored harvest. Out of all of these 16 things you see on the left-hand side of the screen right here, only one wins in all 4 categories. And that's number 12, maximum funded insurance contracts. Now, this isn't a one-size-fits-all. This isn't the only thing that everybody should look at, but it's definitely should be part of your portfolio if you qualify for it. It is insurance, so you got to qualify medically for it. But it also, because of that, gives you so many great tax advantages. Now, one of the things that we talked about in inviting you here tonight was a concept called Be Your Own Bank. We use life insurance, as have the Rockefellers, the Vanderbilts, and some of the wealthiest families in history, to teach people how to be their own bank. But let me ask you something. Why do you need a bank in the first place? What is the one thing that banks have that most people don't? They have money. So these tools work really, really well to allow you to be your own bank. How does that work? Well, so if I go to the bank, and being my own bank works simply, right? It's called arbitrage. If I go to the bank and I make a deposit of $100,000 into a certificate of deposit, a CD, and they promise me they're going to pay me a 4% rate of return, my money's not liquid. It's tied up in the CD, and they're paying me a guaranteed rate of return. The bank is going to immediately turn around, and if I want to borrow money from them to buy a car, they're going to loan me money back at 8% or 9%. That's arbitrage. That's how the bank takes your money, gives you a guarantee, and turns around and invests your money by lending it out. The amount they're able to lend is obscene. Those things we're not going to talk about tonight. Why insurance instead of banks? But in order to be your own bank, you've got to have liquidity. You've got to be able to put your money into a vehicle and take it right back out. And properly funded life insurance contracts can work very well that way. If you got a lot of money to throw into them up front, we can stage it that way. If you got to accumulate for several years and you get started, and then maybe in 10, 15 years or 20 or 30 years, your kids want to buy a car, and instead of going to the bank, they go to the family bank and they borrow from you and pay you interest, or they borrow from themselves if you've taught them these concepts. So to be your own bank, you got to have capital, and that's what banks have. So let's talk about what a bank is. It's an institution for lending, exchanging, safeguarding money, and in some cases issuing notes and transactions and other financial business. So when I have my money into one of these properly funded and structured life insurance contracts, and I reach in and take my money out, I'm borrowing that money. But guess what, guys? I'm not even borrowing my money. I'm borrowing money from the life insurance company. My money is still sitting right there, participating in the index and growing. That's why it distributes the way that it does. So, and if I lose you on this, you'll pick back up. Get your questions, like Jody said, have a notepad. But in order to be a bank, you've got to be able to have arbitrage. So if I can borrow from the insurance company at 6% and avoid paying 9% to the bank for a car loan or for a home equity line of credit to do repairs or anything like that, then I should probably be my own bank. I should use arbitrage myself. And so being able to reach in and take your own assets out to put a down payment on a house, if you want to do that, if you want to help your kids with a down payment on a house, or you want to pay for college. I mean, one of the things that we talk to people all the time when you're using life insurance contracts is most people want to pay for their kids' college. If you're talking about family planning and retirement planning, they say, I want to pay for my kids' college. That's my number one goal. And I was like, so do you want to pay for the classes or do you want to pay for the diploma? And so I say, leave your money in your own bank and let it continue to compound. Have those children take out student loans in their name and pay for their tuition. And then when they put the diploma in your hand, you can either pull your assets out of the bank and pay off those loans if you so choose, or you can take over the payment on those loans. But guess what? If they don't finish and they don't put that diploma in your hands, that's their debt. That's not your debt. So it's a very big carrot to be out there in front of them. So that's a food for thought kind of thing. That's another way you can use this as your own bank. There are comparisons to like tax deferred things that people use traditionally for education planning and those kind of things. And guys, I'll be the first one to tell you, I am an IAR. I'm an investment advisor. So I don't just do insurance. I do all kinds of things. Every single financial product that's on the market has a place somewhere, or it wouldn't have been designed by the institutions. So I'm not saying that things that I'm talking about are bad, like 529 plans or like other, they have a place, but I'm saying you need to have someone teach you all the concepts and educate you so you can make the right choice for you and how to use that moving forward. So bank-owned life insurance, guys, this is one of the things I'm telling you. Instead of putting your money in a bank, putting your money with a life insurance company. A lot of people ask me about FDIC insurance. No, life insurance, they're not FDIC insured. The money there is not. But guess what? Banks can loan out 10 times the amount of assets that they have. And I'm spitballing here, but I'm pretty sure that insurance companies have to have twice the amount in reserves that they actually have on loan. So solvency with insurance companies is not an issue. But this is one thing that's funny. Even if you put your money in a bank, a lot of times it's going to a life insurance company for the very reasons that I'm talking about. Bank-owned life insurance is a real thing. It's a form of life insurance purchased by banks where the bank's a beneficiary and or the owner. This form of insurance is a tax shelter for the administering bank. Now let's talk about banks and life insurance assets. Ever heard of Bank of America? How about that? That's just the number of dollars they have in life insurance assets. Wells Fargo, JP Morgan Chase, US Bank. These are all bank-owned life insurance assets that I'm talking about here. So these concepts, they're not new. They're just not taught to you. And that's why at HGI, that's our number one mission, is to educate. And we want people to understand the options that they have, every single one of them. And then we want them to make an informed decision about what they need. And then we want to have every product we can offer them so that we can help them with those decisions. Fun fact, owned over 200 billion in bank-owned life insurance policies. All right, so let's talk about famous entrepreneurs who use life insurance as their own bank. Anybody ever heard of Walt Disney? Walt Disney World was built on life insurance and being his own bank. McDonald's, Ray Kroc used life insurance for a lot of things going through the process. Guys, as I said, this is the financial matrix. We're trying to unplug you from it. We're trying to teach you the concepts that you may or may not have heard before. Hopefully, if you've heard these before, these kind of resonate with you and bring them back to the front, and you get your questions piqued, you get them answered. This again tonight is not designed to give you all the answers. It's designed to give you that red pill and change your paradigm about the way you see money and about the way you see your preparedness. Because if you don't change the way you prepare, you will not change the way you're destined to not make it in retirement. So I don't want to be a doomsday person, but I hope that you guys got that. I'm so excited about these concepts. And Jody, I'll bring you back on. I won't introduce my better half. I'll let you do that. But you guys are in for a real treat. Jody, thank you very much for having me on here tonight and allowing me to do these things with you guys, because I absolutely love what we've got going on here.
Thank you. Thank you, Zach. Did an incredible job. Appreciate all of you being on and listening. And I think he's the best in the business at what he goes over. I always feel a little bit smarter every time I hear him talk. So these are fundamentals. You got that basic building blocks, that rule of 72, compound interest. You want to make sure, everybody knows when you go to the bank, they know things you don't know. And it's like buying a car, you're probably getting taken advantage of. You just don't know how. But we're arming you with the tools. And also know that we aren't here just for tonight. We're here to be able to give you any feedback that you need. And we got a great team of people who will do that absolutely free, because we want to go out and help you. Now, we all want all of you to act on this. Hopefully you'll follow up with us, but whether you follow up with us or you just act on it yourself, go act, go take a step forward. We want to give you enough confidence, because people got paralysis. They're scared. They don't know what to do, and they're confused. We're trying to put all this together. So now we're going to hear from the great Kimberly Odie, who is the other half and partner with Zach, who just spoke, and she is absolutely phenomenal. She's a woman on a mission. She's an incredible lady, and I think she's priceless in this business, and I think you're going to love her perspective. So Kimberly, take it away.
Yeah, thank you. I always love when you introduce me, especially when it's recorded, because then I can just remind myself exactly what you think.
Mm-hmm. You bet.
Well, again, as everyone said earlier, welcome. I'm glad you're with us tonight. This whole stream stuff is new to me, so if it's not working, you guys will just have to let me know, because I can't see it. So anyway, when we sit down and we talk about money, and we talk about money with people, the biggest thing that they need to know and they need to understand is how much money is in their bucket. And that's really what this looks like here, right? Is how much money is in their bucket? What does it look like? If you want to retire today, how much money do you have to have in your bucket to retire? And it really depends on how much income you want coming in on a monthly or annual basis. So I'll stop here and I'll ask you, do you know your number? Have you ever thought about it? Do you know how much money you have to have in that bucket so you can say, yes, I want to retire? And the other question that I'll ask you is, when you retire, how long do you want to be retired? That's a rhetorical question, obviously. You want to be retired forever. Most people do. They don't want to have to retire and then realize they ran out of money and go back to work. So whatever we have in our bucket has to last us forever. So I want to teach you guys about the rule of 25. It's not in my slideshow, so you're just going to have to listen to me talk to you about it. But ultimately, the rule of 25 says that if I want to have $100,000 a year income, all I need to do is multiply by 25, and that's going to tell me how much money I need to have in my bucket to pull out $100,000 a year. So if I want $100,000 a year income multiplied by 25, that means I need $2.5 million in this bucket to retire with $100,000 a year. I can tell you I've been doing this for a very, very, very long time, and there are very few people that I've ever met with that have $2.5 million, which is why you need to talk to someone. It's why you need to understand how money works, what your tools are, what your options are, what your choices are, in order to make things work differently for you guys. So in retirement, most people are only focused on one of two things. What is that? It's accumulation or income, right? And at retirement, we want one or the other. Depends on what our money looks like. So what's most important to you? You guys can ask yourself these questions. If you want accumulation, especially at retirement, you're looking for safety. You're looking for tax control. you're looking for a decent yield, you want estate planning benefits, and you want liquidity. You're in retirement. This is what we want now. And if you're looking for income, do you want income now? Like, do you want to retire right now today and have income to last forever? Or do you want that income to be later? Do you want that 10 years from now or in the next 5? Do you want a portion of that money guaranteed for the rest of your life? Or do you want to have to worry when the market goes up and down and worry about the volatility of that? It's up to you. And do you want control of the underlying value of the asset that you've invested in? I think most people would answer yes to all of those questions. But spoiler alert, there's only one thing that can accomplish all of this. Only one. And it's an annuity. And a lot of times when I pull up this slide and I say this to people, it's like a hush falls over the crowd, right? They're like, oh, what'd she say? And here's my next slide. Is annuity a bad word? Sometimes to some people it is, right? Because they know old annuities, not new annuities. Things change, products get better. And you know, the things that were bad are gone now from that world. So is annuity a bad word? No, it is a good word. And I'm going to show you why. So when we talk about that rule of 25, how much money we need in your basket, right? How much money we need in your nest egg. That says if I want $100,000 a year, multiplied by 25, then that's going to give me $2.5 million. Well, there's also a rule called the 4% rule. And the 4% rule says that if I have my lump sum, we're going to use $1 million on this one. If I have $1 million sitting in my basket and I want to be paid out for a 30-year period of time, which is basically period, over your lifespan, with a 95% probability that it's going to last me for that entire period of time, how much money can I pull out of this bucket? Because like Zach said, like Jody said, you can climb Mount Everest, which is amazing. That's what we do, right? At the pinnacle of our career. And then we drop the mic and we say, we're done. The only problem is we got to go back down the mountain. We got to get down safely to the other side. And in retirement, that means that you're going to have that money last you for the rest of your life. So the 4% rule says this is how much you can take out of your nest egg every single year and not deplete your assets with a 95% probability over a 30-year period of time. So if I have $1 million in my bucket, and I can pull out 4% a year, that means that I can have $40,000 a year income coming in from that $1 million bucket. I don't know many people that have $1 million saved, and I don't know many people that have that can live off of $40,000 a year. So there are definitely other things that you have to think about when you're planning for retirement. How can you save? Are there smarter ways to do so where maybe we can get more than the 4% rule? Should I have a business? Should I have some passive income? All of those different things play in. But let's talk about this 4% rule. If I want to pull $40,000 a year, what if I could show you a way to invest half of that for the same guaranteed income? Would that make sense? Then you could have the extra $500,000 to use however you choose. I don't care what you do with it. You can get one of those money guns and like blow it out on the interstate with people around you, and they can write a paper about you and say how amazing you are. Go on a trip around the world or save the world. It doesn't matter, because that $500,000 would be free for you to use however you wanted, because you've got your income guaranteed with something else. Would that make sense? I think absolutely. So if you look at this example, this is showing someone putting $542,000 of that $1 million that they had, right, into a product that is going to guarantee them $40,000 a year every single year for the rest of their life with zero volatility. That's huge, guys. I don't know about you. I haven't been retired yet, but whether you're retired or you're not retired, you don't want your income to fluctuate. If anything, you want it to go up, you don't want it to go down, and you certainly don't want it to go away. So when I retire, and whether I'm sitting on a front porch or I'm sitting on a yacht, I want to know what my money is every single month for the rest of my life. And I don't want to have to worry about it. We worry enough while we're working, right? So if you had the ability to spend half of your assets on that same income stream and take the rest of it and do whatever you wanted to with it, doesn't that make sense? To me, it makes perfect sense. And another spoiler alert here, there's only one thing that can accomplish all of this. And you guys already know what it is because I told you earlier, but it's an annuity. So I want you to think about that when you're thinking about your money. If you're not at retirement age yet, this probably isn't the part of the conversation that is for you. But if you are and you're looking for that pension and that guaranteed income stream, it is so important that you talk to somebody that can give you those options and those choices. Obviously, we're going to wave our hands and say, call us, because you should, because we're the best. But regardless, figure it out, right? Meet with somebody that's not captive and can really truly teach you what your choices are. This guy's name's Tom Hegna. He's famous in our industry. He's been a life insurance and annuity professional for his entire career. And that's the biggest thing he talks about is retirement is about income. It's not about assets. You can retire on assets. You can't retire on assets, but you can retire on income. So guys, that's what I want you to think about tonight is as you're looking at this, as you're talking about this, to your financial person, whoever invited you here tonight, what do you need to have coming from your nest egg? How big does that nest egg need to be? Do you need to be doing something more than a 401k? And what is it going to look like? Please don't just blindly invest for the next 20 or 30 years and wake up at retirement because you think it's perfect and you think it's time and you can't retire. So take control of your future. Thank you so much. Jody, thanks for having me. And I'll turn it back over to you.
There we go. Got to unmute myself again. But I am so excited with this program. Now, listen, we're toward the end. You've heard a lot of information. You've taken the time to be here, but let's gird it up. Let's finish this thing strong. Now, we're in the future. Let me give you a little teaser of what's coming up. We're going to be doing these at least monthly, and it's going to be over all kinds of subjects. One of the things that sets us apart is we're not trying to say annuities for everybody or life products for everybody. But we're going to teach you all the concepts. The next time we're going to talk about living benefits. We're going to talk about money under management, which is a stock play. We're going to talk about estate planning. So we got lots of things we will be able to teach you the tools that you need, give you the tools you need for you to make great decisions. And you know what? I can promise you right now, the marketplace is a phenomenal place as you have all these people that are getting ready to retire. The things that Kimberly just said are going to save families as you go learn all these concepts. Now, to wrap it up, as we get ready to finish, you're going to hear from the great Mauricio Garcia, and he has such an incredible overall, just plethora of knowledge and when it comes to financial planning. But listen to what he has to say, because you may be on this call thinking, I just got to hope I can pay my mortgage next month. Yes, but you know what? We hope you're going to build wealth. And when you do build that wealth, you're going to want to know what to do with it. So if you're in the wealth business, building creation side of things, and you really want to go out and learn some tools that you can sound impressive to your neighbors, bear down on this. We got about 20 minutes left as we finish up. So focus, you blow through that finish line. Great. Mauricio Garcia. Thank you, buddy.
Thank you very much, Jody. And, this topic that I'm going to cover today is really a topic that I believe will impact most Americans than you can imagine. I like to put out these numbers just so that you can have it in perspective. If you were to Google, what is the total value of the stock market today, right? Everybody talks about the stock market every single day. A lot of you probably look at it every day, maybe every week, maybe every month, whatever, but you know what that is and why it's important to be tracking it, because most of the people's retirement are tied to the stock market in some way or another. And what I want to say is that there's maybe if you Google it, you'll probably find that is somewhere between the 55 and the 60 trillion dollars in value, depending on when you look at it. But it's really mind-boggling to know that about 45 trillion of that, 47 trillion of that is actually in these things called IRAs and 401ks. And as Zach was saying, that a lot of us, as we go through like a formal employment, we have access to these programs, right? And then when we leave these employees, because if you think about how many jobs people are having today, right? Between the time they stop working and the day they retire, it's 7 to 10 different jobs. So you probably will have more than one 401k that when you leave, you'll probably transfer and roll over to an IRA. So needless to say, the massive amount of money there, it's probably somebody or yourself have one of those accounts. So I'm going to share my screen real quick to go through a presentation that will explain to you, depending on what you feel taxes will be like in the future, whether you want to continue to fund it indiscriminately, or maybe be more strategic and fund it to a certain degree where you don't jump into or create an unintended consequence, fiscally speaking, in the future. So let me see if I can share this right. If I have my PowerPoint here we go. Because I was doing, well, I'm just going to share my full screen, which is the best way, I think. So here we go. So Andres, let me know, or hopefully you guys can see the PowerPoint. So I call this the IRA Mastery, and we're going to fly through this about 15 minutes. It's typically more like a 30-minute presentation, but we'll do this. There's some of the strategies that you'll learn about how to extract hundreds of thousands, if not millions of dollars out of your IRA without taxes. Quick disclaimer, I'm not a CPA or a tax planner. I'm a financial professional, but this is what we deal with every day. Obviously, it's hard to keep track of the national debt. I mean, it's not, I was meaning to say, because of how fast it rises, right? Last time we did a presentation, it was about 34 trillion. Now it's close to $40 trillion. That's how fast we are moving in this national debt. I remember when I first started giving this presentation in various universities and libraries and restaurants and schools and whatnot, national debt was at 9 trillion. 9 trillion. Now it's 30 trillion higher. So that's just how fast things are moving. Now, why is that important to know? Because it's going to impact your retirement account. Now, the good news about having an IRA or 401k is what? That you get a tax deduction today and that you get to defer that. You don't pay anything until you actually reach in, take the money out. Hopefully you do it after 59 and a half, so you can avoid the penalty, the additional penalty of 10%. But what comes with good news is typically some bad news. And the bad news is that every dollar you take out from this account when you retire is going to be subject to income tax, not capital gains, it's income tax. And obviously, if you're like most people, generally you'll continue to contribute to that until you retire. And if you're like most people, again, you'll probably keep that in there until you have to take the money out, like when you're 70, 72, 73 years of age. Notice that all the money you have today and all the money you will accumulate will fall in one of these three buckets. Obviously, your taxable bucket is the money you put in any investment. They can be buy stocks, bonds, anything that you invest in typically would be taxable when you sell it, right? Capital gains tax. And then where most of the money is, which is what we're going to be focusing on today the most, is the tax deferred bucket. That red bucket right there is the more tax hostile environment if you don't use it or set it up strategically. And then, of course, we have the third bucket that many of you also have money in, which is your tax-free. Zach spoke about one phenomenal tool, which is the IUL. We have the Roth 401ks, we have the Roth IRAs, and you could even say, HSA. But there's some tools that are out there that are tax-free, have tax advantage. But most of the money, believe it or not, is in that red bucket right there. I would even say, and this is not exact number, but if I had to guess, I would say about 90% of the money for retirement is in tax-deferred accounts, and maybe about 10% is in tax-free accounts. So it forces you to think why that has been the behavior of Americans, right? Of putting all the money in that red bucket. The only thing I can think of is they want the deduction today. But if you ask a room full of 100 people, how many believe that taxes are actually going to be higher when they retire? 99% of the people will raise their hand and say, yeah, I believe taxes will be higher when we retire. And so begs the question, then why are you overfunding it if you're going to pay more taxes when you reach in? Wouldn't it make sense to do the opposite? I hope that makes sense. Anyways, important to know a little bit of history, because those that don't know the history tend to be victims or fall victims of it, right? So this is the tax chart just since 1913. Remember, guys, 1913 is the first year that income taxes were paid in the United States. And from that, we've been up and down and up and down and up and down and up and down. And so we have been as high as 92 or 94% after Second World War. And so back in those days, if you earn more than $200,000 a year, 94% went to a federal government in form of taxes. Obviously, that was a lot of money back in the day, but people are accumulating millions of dollars in their IRAs, millions. As a matter of fact, most people have more money in their IRAs than their homes are worth, and homes have really appreciated in value, right? Just perspective again, 45 or 47 trillion with a T are in these retirement accounts. And so the question is, if we have been that high, we are, if you look at the chart, and where we here, although this goes to 18, but we've been pretty much in that low side. Historically speaking, we are the lowest we've ever been. And at $40 trillion, or approaching 40 trillion in national debt, what is the likelihood of taxes continuing to drop instead of going up, right? So here's what I want to talk about. Let's talk about Joe and Carol to wrap this up. This is a typical couple, right? They both worked really hard. They were saving money. They made it to age 65. They built up $500,000 together, right? Just on the IRA. They probably need more money because, as Kimberly was saying, maybe your number, the size of your nest egg, to be able to maintain the lifestyle in retirement is probably going to require more than $500,000. But let's just say that the $500,000 is what they built on their IRAs. And let's also assume that they, they're conservative, so they expect no more than 6% return on their money. That may be too conservative for some of you, and maybe for some of you will be even a little aggressive. But let's just roll with that number. They are self-insured themselves. They have no long-term care. So if they become unable to bathe themselves, eat, cook for themselves, and move, they'll probably depend on children or each other. So that's going to be a heavy thing, but they want to self-insure, use their money for that. And so here's what's going on. And please, I promise you, this is the most, how do I say this? This is the page with the most numbers that you'll see. The rest of it will be easy, but follow me. I'll take you through. Up here shows the age of this couple retiring with $500,000 in their IRA. Like I said, they are following a behavior that most Americans have proven to follow, which means continue to defer the IRA until you can no longer do it, which is for most people right now would be age 73. Now that could change in the future. But that $500,000 growing at 6% would be $796,000 by the time they would have to start taking the distributions, right? That's why they call it the RMD, required. You have to. It's required minimum distribution. And so if their IRA, it's $796,000 at age 93, based on their divisor, this is the complex way IRS likes to make things, which basically means that it has to do with your life expectancy. So they call it the divisor. So you have to divide that number, that 24.7 by 796,000 to determine how much money you have to take out to avoid a 50% penalty for not taking what's required for you to take at that age. If they want their taxes, they want them now. After 73, you can no longer just continue to defer on the full amount. And so if this couple is in a 24% tax bracket, it means they have to write a check to Uncle Sam for $7,743 that year alone. And so from that moment forward, they're going to have to take a distribution. And if you notice, every year that goes by, that divisor shrinks. And what did we learn in elementary school? When you divide by a smaller number, what did you get? Well, you get a bigger distribution. And so over here by age 80, age 85, they're having to take, $54,000 from an $891,000 balance. And so make a long story short, let's say they make it to age 90, which is it's not a moonshot nowadays that one of the two could make it to age 85 or 90. So if you add up all the required minimum distributions between 73 and 90, that will total $925,000 in distributions. And again, they were at a 24% tax bracket, means that they paid the federal government $222,000 just on RMDs. And even after that last distribution, there was still $798,000 in that IRA that if it's going to their children or their grandchildren, guess what? they will have to take, according to the current Secure Act, the current law, they have to take that money within 10 years. Basically, it's not tax. It's not a tax-free transfer. It's not a step-up in basis. It's none of that. They have to pay. The children will have to figure out a way to pay taxes on $798,000 today, or more than that if they continue to defer that over the 10-year period. And so, what is the potential solutions then somebody have in order to be able to enjoy more of that money, especially if they think that taxes are more likely to be higher in the future than lower? Well, there are some methods, and I'm going to share with you one of them because of the time. And if you want to learn more about this, we'll put a calendar on the chat here on YouTube, and you could go there and schedule a one-on-one, or the person that invited you to join us today will probably reach out to you to do what's called a financial needs analysis, where if you have an IRA, you need to know what it is what it means to insure the IRA, or what it is to do an IRA arbitrage strategy, or what is a strategic IRA rollout, or what it is to convert to a Roth. So these are different ways and different strategies. Some of them you can combine to have the best outcome. In terms of what that means actually is you get to spend more of that money that you so responsibly looking to the future put aside. But let me give you an example. So here's the hostile money, right? Or what I call the highest tax asset, IRA, and you want to convert it to something like a Roth IRA where it's tax-free. You can't just move it without having to pay a tax. And that tax is going to be paid either now or it's going to be paid later. So that's why I again say it is really going to depend on how you feel and what you think in terms of looking at the trends, looking at the data, like looking at the sky and seeing that it is cloudy and the clouds look really dark and there's wind and now there's lightning. So what is likely? Is it more likely for rain to happen or for the sun to just come out and shine? Well, probably it could shine after the rain. But you know what I mean? If you see the indications there that taxes are likely to be higher, then maybe what you want to do is something like this, right? This is called a strategic rollout, where you figure out what is your bracket, the bracket you are in right now. So let's just say you're on a 24% like this couple. And after you add up your AGI, your adjusted gross income, and I don't want to get too technical here. We can work with your CPA on this, but it's basically your taxable income, right? And that'll determine your bracket. But your bracket goes to a certain limit, like, you know, a certain income. If you file taxes married jointly, you know, up to a certain amount of income keeps you in a 22% tax bracket. And then if you make more, then you can go to 24% and so on and so forth until you reach the 37%. So the idea, the strategy here is to figure out where you are right now and how much can you convert from your Roth from your IRA, to a Roth and keep you at the same bracket. And so for this couple, it turned out that they could convert $67,934 that year, and they did not have to jump higher than a 24% bracket that they were in to begin with. So it took them 10 years to convert that whole $500,000 into a Roth IRA. And it's important to mention here that for many of you, you may not need to convert all of it either. Right. And I'm not going to get into why, but you may need to convert 70% or 60%. It depends on what other sources of income you'll have and, you know, your standard deductions and things of that nature. But to wrap it up, I would just say that if this couple, we determined, let's say they had a great pension and they needed to convert this whole thing. The taxable distributions were $679,000 total by converting to the traditional IRA to the Roth. Now, if we compare that to before, you see before adding up all of their RMDs, which were taxable, and then leaving the money to the children, which was taxable. The before taxable distributions from that $500,000, up until age 90 was 1.7 million. In other words, the road that they were on is a road that would lead them to pay taxes on 1.7 million. If they do the sequential conversion over that 10-year period, they only pay tax on 679,000, eliminating tax on $1 million. And not only did they eliminate the tax on $1 million, they eliminated the risk of what if taxes were to double. That would be a major success. They avoided not just paying tax on $1 million on 24%, but paying tax on a double the amount or triple. Who knows, right? I mean, look at history. We have been in the 70% tax bracket. We've been in the 94% tax bracket. So who knows? But that may be something for you to consider in your overall strategy. And it's something that most people, most financial professionals never talk about, because it's just easier to defer until, you no longer can. And then I guess just follow status quo. But it is our job to show you what's really going on in the matrix there, and know that there are things you can do to have a better outcome. So which of the strategies is best for you? We don't know until we actually sit down with you. If you have a 401k, an IRA, a 403b, et cetera, we can determine that. So Jody, if I'll throw it back to you, if you want to close it for today, I think is the best thing to do today for you to close it out. Let me bring you on stage, Jody. There you go.
You had me on there. There we go. Listen, guys, we flew through this. We got through in 1 hour and 20 minutes. And listen, I know we took from the fundamentals all the way up to some high-level things, but you know what? The more you hear these, the more excited you are to be able to be in that situation. And here's what I love. If you have someone who's won the corporate game and they have money saved, we can help them. If you have the other half of America, which doesn't have 401ks because they're out, they're self-employed, and they're looking for answers, we got all those guys too. So we got great programs lined up. We'll be right back to you. But the key's in the follow-up, guys. We do a free financial review for you. We'll be able to talk to you about all these different things. We come to you with an educational approach. So follow back up with us, and we will be following back up with you. Thank you for taking your time on this night to be here, and we look forward to doing great things in the future. So until we see you again in about a month, have a wonderful night, and thank you for your time.